Okay, so let's look at a sample pay stub here. Okay, so this is uh, just some pay stub I found online. Um, I think a lot of you guys would probably be familiar with you know what these are, but I'll just kind of walk through it. So you have the employee's name here, and this looks like they're an employee of UNC, Chapel Hill University. Um, it has their pay rate, their title, what department they work in. You can see here that their filing status is single. Why does that matter? Why does your filing status matter? Yeah, so the tax brackets are different. Okay, so if you're filing married, you can earn more and pay less tax. There's also a difference in the deduction. Like there's something called a standard deduction, which is like kind of like an automatic lowering of how much uh, taxable income you have. So if you're married, you have a larger standard deduction than if you're single. So there's various tax implications on what your marital status is. Okay, so there is some form of discrimination in this country against single unmarried people. Okay, we have not the tax advantages of a married couple because there's some social engineering that every government does, and so our government, like most governments in the world, want to promote family formation, so they give tax benefit for that. So this will affect kind of your tax withholdings because depending on what your filing status is, your taxable the same $100,000 salary is going to be taxed differently whether you're single or married, filing jointly, married filing single head of household. There's all these different filing statuses that will change the amount of tax that you're going to owe on the same salary. Okay, so the filing status matters for that. So you can see here uh, the hours and earnings. So this is like year YTD stands for year to date. So it shows your earnings uh, for the whole year so far. And then in this current pay period, it's going to show how much regular pay, sick pay, bonus leave. So it's going to have all these components of your pay. Um, and then it will show your gross amount here, $1,627.74. So this is kind of how much gross amount you've earned. It's going to have all your taxes. So federal withholding, so that's income tax that we talked about, income tax withholding, federal Medicare, federal OASDI. So we'll talk about what these two are. Medicare is for a senior retire, like senior medical. When you're over 65, you're entitled to medical care through the government. So up until then, you're going to contribute to that. OASDI is Social Security. So you're also, depending on how much you contribute, you're also going to be entitled to a check for retirement. And if you're disabled somehow, there's some coverage there. But until then, you're paying into that. So you can see that, you're paying $182 for income tax withholding, $22 for Medicare, and $94 for OASDI. And then NC withholding. What do you think that is? So, but what state is University of North Carolina, right? It's in North Carolina. So this is state income tax withholding. And then what else do we have here? Some other deductions. So they have NSERS retirement. So this is like their pension, critical illness. This is probably some kind of insurance, uh, parking, life insurance, dental, cancer. So you can see here, this is how much that the employee is paying. So let's look at dental plan, $10.61. State health plan, $7.52. And then you can see here how much the employer is paying. Okay, so they're paying into the retirement 278. The employee is paying 97. So you can see here that this is better than matching. The employer is contributing $278 and the employee is only contributing 97. Okay, so the employer is hooking this person up with retirement, right? It's money going into this person's retirement account in their pension. Okay, and the employer is contributing a lot, almost 3 times as much as the employee. Same thing with healthcare, right? The state health plan 80/20, the employer is paying 240 and this employee is only paying $7.52. So you can see again, the employer is contributing a lot to the healthcare, um, though the employee is contributing some. Okay, so you can see here, if we do this, the total deductions is $199. Um, and so you can see here the total deduction. So the total taxes is from here. So this is what it's taken out for taxes. And you can see that, um, where is this? Right here, 360.68, right here. The deductions is basically this 199 plus this 27 is here. And then your net pay, the amount that's going to be in the paycheck is only $1,023. Okay, so we started with the gross 1627, and around $600 was taken out for all this stuff. So yeah, so now hopefully when you look at your paycheck or your pay stub, you're gonna scrutinize it a little bit and see where your money's going to. But I suspect it's gonna be the traditional stuff. Like this stuff is kind of standard. Okay, federal income tax withholding, Medicare, OASDI, and state income tax. That's gonna be kind of standard stuff. Okay, so it is not too good to be true because the old system was a pension system. Now there's very few employees in America that get a guaranteed like pension. Okay, it's mostly state workers and like firefighters, cops, teachers. The benefit of that system of pension is that you are guaranteed a payment every till you die. Okay, so uh, it gives a lot of security to the employee. Okay. Now the problem with it is that let's say the stock market is down, or the however you've invested this money that's being contributed to the pension is mismanaged. Okay. There won't be enough money from the investments to pay out those employees. Okay. What happens in like for state workers, the state of California will have to take money that it's going to spend on schools and all the stuff that the state has to spend money on. It's kind of guaranteeing the pensions for all the state employees. So if the state pension fund does not do a good job of managing the money so that there's enough that grows through investment to pay off the pensions of the people, the government is going to have to step in and take money out of their budget to pay for that. And you can argue that a lot of the calculations that the state like pension funds are doing are not sustainable. Okay. Like they assume like an 8 or 9% return over 30 years. They're only achieving 5 or 6%, right? So that means that on the back end, there's going to be a big shortfall. Okay. So uh, businesses that offered pensions had to take this same risk, right? So they're like, forget that. We don't want to take the risk by guaranteeing a payment to our employees when they retire. We would rather just contribute money to them, and just after that, it's their problem. Whatever happens in the stock market, it's not our problem anymore. So what they've done is gone from a guaranteed benefit, which is what a pension is, to a like a contribution. Okay, where they guarantee how much they're going to give right now while you're working. And so a 401k, like what that is basically is you're contributing money. It's going into some investment account, and the employer is also putting money into that investment account. After that, what happens in 30 years, they're not going to be liable for that. So if the stock market crashes or it doesn't grow that much, that's going to kind of be on you, right? Because they've already given the money to you. Their hands are now wiped clean. That's the trade-off that they're kind of making. So in some ways it's good because you're getting this money from your employer, but it's not as good as a pension where it's like guaranteed, you know? And of course, really the guarantee is only as good as who's guaranteeing it. Because a lot of like companies went bankrupt over their pensions because they had this huge liability and they just couldn't pay it. They couldn't operate their business and pay the pensioners, so they just kind of went out of business. So all employers, private employers, have moved away from pensions because it's the long term risk is too much. Okay, so this is a form that you fill out when you first get a job. I'm assuming many of you have seen this. What it's doing, see, you're asked to make, what is your filing status? Your employer obviously knows how much money you're making because they're giving you a job. And then it's like asking how many kids you have. It's asking all this information because they're trying to estimate how much income tax you're going to owe. And based on that, you're basically, that's how much they're going to withhold in your paycheck based on this W-4 form. So this is not, from what I understand, it's not illegal. Okay, so I looked this up a couple years ago. If you wanted more of your paycheck, you could just write, like, it asks like how many dependents you have. You can boost this number up. Okay, the more dependents are on this form, or the more kind of credits for that you have, the less they're going to withhold from you because they assume that your tax liability will be lower. And then as long as you can pay the tax when you actually file, if you have some other use for the money, like if you want to invest it, or if you have some other business or something and you want more of your paycheck, you could manipulate this form. And again, don't take my word for it. Look this up yourself. It's not like tax fraud to do that. Okay, as long as you pay the tax on the back end. But they're trying to do that because Americans are notoriously poor savers. So, unless you're sure you can do that, because you will owe the tax, because you don't actually have the kids and stuff.